Hello and welcome to another episode of Finance Footnotes Fast 5, where I give you 5 timely market ideas in less than 5 minutes. I'm your host, Brent Stransky. Today is September 2nd, Tuesday. Let's get started. First point I want to share with you is that markets ended the month of August at all-time highs. Through August, S&P 500 stock market index was up over 9.8%, up 3.75% in the month. In fact, it was up May, June, July, and August. It's only happened 10 previous times over the last 50 years. So it's kind of an uncommon occurrence. I have other market indexes here for you to take a look at if you want to pause the screen. But I also want to share with you 2 reasons why that happened. Why was August such a good end of summer? Number one, the market was caught by surprise on August 22nd. Federal Reserve Chairman Jerome Powell announced his dovish stance on interest rates, saying that even in September, which is this month, the Federal Reserve may start lowering interest rates. So that caught people off guard. The markets rallied hard. We'll talk more about that in just a minute. And the second major occurrence that happened is that corporate earnings in the second quarter started coming through, and I have a chart here, up almost 12% year over year. That's very good. So earnings came in very good. That's a driver of stock market returns, and the Federal Reserve policy may start lowering interest rates as soon as this month. Okay. The second point I want to share with you, though, is in spite of this, the market at all-time highs, according to a Wall Street Journal article this morning, price to sales ratio, one measure of market valuations, is the highest ever, meaning things are the most expensive ever for the S&P 500. It costs $3.23, $3.23 to buy $1 of sales, which is the highest ever. There's a chart there on the screen. The more common metric that we follow is price to earnings ratio, not quite at all-time highs, but at 22x forward earnings, 22 times forward earnings, certainly very high compared to the 25-year average of 16. 2 things. Number one, these are not any good indicators of market direction going forward over a 1 or 2 or 3 year basis. But over a 5 or 10 year basis, it would be smart to assume that stock market indexes, especially the S&P 500, is going to have lower than average returns over longer periods of time. And the second thing is, well, what should we do? You should talk with your friendly financial advisor about using other asset classes in your allocation if you haven't done so already. Point number 3 I want to share with you is another Wall Street Journal article this morning talking about how pessimistic Americans are. I was really surprised to see this in the marketplace. Only 25% of people in the survey say they have a good chance of improving their standard of living going forward. It's the lowest since polls began in 1987, almost 40 years ago. Really surprised to see how many people are feeling pessimistic in the market, but you can imagine why. Inflation, the political rhetoric at the moment is very divisive or divisive, depending on who you want to pronounce it with. And of course, home prices, debt levels. There's another chart I have on the screen here. It talks about 44% of people view the economy as good or excellent, which is actually historically high. But if you look at this chart here, going back over the last 25 years, you can see that most Americans believe the economy is poor or negative most of the time, sometimes reaching as high as well over 75%. So unfortunately, people are pessimistic while the market has done particularly well and things look particularly good. So that was the third point. Number 4, just moving a little bit, I think home prices have been on many people's minds. Home values are the majority of Americans' largest asset class or largest asset. So I wanted to highlight that the 30-year mortgage has started to come down. It's at a 10-month low as of this weekend at 6.36%. Of course, better rates if you have better credit score. This is a 10-month low, okay? And depending on what the Federal Reserve does this month, rates could go lower. We'll have to wait and see. It will be interesting to see because home prices have started to stagnate over the last year over year through June. This just came out last week, but there's a 2-month lag in the data for some reason from the government. But it's up only 2%. This is actually stagnating over the last several months. And it'll be interesting to see if lower rates increase home prices because home buyers care more about the overall monthly value as opposed to the total home price, okay? And then finally, I want to end on an optimistic note, as I usually do. I want to cut through some of the data and give you one optimistic point that you can take home. And that's on August 22nd in Jackson Hole, Wyoming, when the Federal Reserve Chair Powell made his dovish comments, which were aligned with President Trump's, and they're both seem to be moving in the same direction about lower rates, okay, based on what's going on in the economy now. It really spurred caught markets off guard. 90% of stocks were higher that day, and 90% of trading volume. This is called a 90 day. It's very uncommon. It's happened only 12 times over the last 45 years. Markets were higher a year later, 11 of those 12 times, 92% of the time, with a median return of over 20%. So certainly reason to be optimistic. I'll be sharing more data with you again next week. If you have any questions, please let me know.